we're a little on the accommodative side.
I think we're shifting to a place where it would be most appropriate for them to start raising rates.
The market has this angst around the reaction function, around Fed credibility.
He actually has to take action. Words are cheap.
If you look at the inflation picture in aggregate, it feels like it is sort of a call to action.
This is Bloomberg Surveillance live from Jackson Hole with Tom Keene and Lisa Abramowicz.
From Jackson Hole for our audience worldwide, this is Bloomberg Surveillance on television and radio. We're sitting in front of the Grand Tetons, as we typically do in late August for the Fed's annual gathering. But this year, the view is cloudy for both the rocky peaks and a new era of monetary policy. Kevin Warsh making his debut as Fed chairman at a time when everyone is asking, who is Fed Chairman Warsh and just how different will his tenure be? Good morning. I'm Lisa Abramowicz alongside Tom Keene at Jackson Hole. It feels very different this year. At a time where Kevin Warsh is marking almost 100 days as the Fed chairman.
Well, Mike McKee's been here since 1951. I was here a little bit after that. There have been other times of tension, like in 2007 after the markets blew up, but this time is uniquely different. Total focus on this speech we'll hear.
How much is the long-term yield very much in focus, given how much it has risen since May 22nd?
Really important question. The answer is less than 10 days ago. That's the good news. But you got little tea leaves out there, idiosyncratic Philippine peso out to record weakness this morning, and you see it in the tension of the foreign exchange market with DXY elevated here. You can see in foreign exchange on the Bloomberg, Lisa, everyone's tuned into this.
Let's take a look at what is going on in markets right now. It is pretty quiescent as everyone awaits with bated breath Fed Chairman Kevin Warsh as he steps to the podium in just about an hour time. Right now, little changed on S&P futures, up just about 0.1%. Euro dollar going nowhere after the dollar has lost significant ground since May 22nd when Fed Chairman was sworn in. 10-year yields elevated at 4.68%. Brent lower just a touch, $89.06. Coming up this hour, we've got Cleveland Fed President Beth Hammack, former Kansas City Fed President Esther George, Bank of England Monetary Policy Committee member Catherine Mann, Cornell University professor Eswar Prasad, and in the next hour, former Fed Vice Chair Rich Clarida, as well as Citi Wealth CIO Kate Moore. We have alongside us someone who has been here not since 1951, but who has been coming to quite a few of this. Michael McKee, of course, our chief economic correspondent. How does this time feel different?
It feels a little different in that Kevin Warsh is making his debut here as the Fed chair, and that's always interesting to see how they handle themselves in front of an audience that is their peers, basically. Warsh has been here before as a Fed governor, but he wasn't the person people looked to at the time. Now he is the man who is supposed to give direction to the central bank, which then feeds into direction for the markets, and he's sort of refused to do that so far. So there's a lot of focus on what he's going to say and whether he's going to stick to his guns about not giving guidance at all, let alone forward guidance.
I think it's appropriate that it's kind of raining and cloudy right now. It kind of gives a scene setter. It gives a sense of just the mood on the ground.
Yeah, yesterday, the hills were alive with the sound of music, and the somberness today really nails it.
Yeah, as clouds rolled in late last night, Fed officials were gathering in the main hall. And joining us now is one of those Fed officials, Cleveland Fed President Beth Hammack. It is so good to have you, President Hammack, on set with us this morning. You have been very vocal about your desire to raise rates, that you think that the inflation has been too hot for too long. Have you heard anything at this meeting that changes your mind?
Well, the meeting starts in earnest this morning with the chairman's speech, and that'll be the kickoff. The data that I've seen since our last meeting has been, to me, very much in line with the picture that I was seeing before. And of course, I'm setting my policy views based on the forecast of where I think policy is where I think the economy is headed, rather than where we were over the past several years. But we've been missing on our inflation target for more than 5 years. My forecast is that we're going to continue to end this year around 3% inflation, and by the end of 27, we'll hopefully get down to the mid 2.5s, the mid 2%. But that's not meeting our 2% objective. So to me, there's no tension in our mandate. We've got an employment picture that's right around my estimate of maximum employment. It's been stable and in balance for the past 12 months, and we've been missing on the inflation side. I don't see restrictiveness in the markets. When I talk to people in the capital markets, what I'm hearing is that capital is free-flowing. Investors are looking to put more capital to work. Businesses are looking to make bigger investments. And so I think we need to put some restriction into policy. And so I believe it's time to act for us to do that. The longer that we wait to get inflation under control, the more pain is felt by everyday Americans and the more difficult it may be for us to ultimately get it back down.
We were talking last night about the meanings of the word reaction function, and some of our colleagues were saying, wow, that's kind of a fancy name.
Super technical
name.
Mathematical formula.
What is it that Kevin Warsh is not doing? I mean, how do you define what Wall Street is looking for, and how do you put your own views into that?
Well, I can't tell you anymore what Wall Street's looking for because now I'm on the policymaker side. I'm no longer on the market participant side. But I can tell you I view communicating about my viewpoints as a critical part of the job. I think talking to the public, listening to the public, hearing what they're experiencing, hearing how they're seeing the economy unfold is a critical part of what I do every day. And I need to help put my views out there so that businesses and households can make better informed decisions. I like to tell people when new data comes in, how is that going to change my perspective? How might that change the decisions that I and maybe my colleagues are going to make? Because I feel like that will help them to manage their businesses and their household finances.
Well, when you look at what the chair might have to say today, kind of the bottom line question for other members of the Open Market Committee is, how do you feel about the idea of not giving forward guidance, and particularly given your background, having the bond market tell the Fed what it thinks is happening in the economy?
Well, the markets are definitely one component that I look at. Financial conditions and FCI indices are something that I spend time looking at to get a sense of how monetary policy is transmitting into the real economy. But having spent 30 years in markets, I can tell you that market participants tend to be focused on making money for themselves and their clients. And they do that by betting on what the Fed will do, not what the Fed should do. And so I think markets are an important complement, but not a substitute for the Fed and for
You're
us taking
underselling
action.
yourself. 30 years, you were sterling in the repo market at Goldman Sachs. There's no one in the history of the Fed that understands short-term paper like you do.
Well,
You
no,
got
I'm
it down.
not sure. No.
But it's true. You undersell yourself.
I think we have a lot of
this.
experts. The staff is incredible at the Fed. That has been one of the most
I will agree on
eye-opening
that.
things.
Plus, you're out of Cleveland Fed, where you invented in 1983 how we look at inflation with the Cleveland series. Do you still see trust in the market before and after this speech? And the litmus paper, the narrowness of the repo market, do we still see trust in what we're doing?
I think our credibility comes from our ability to deliver on our commitment to the dual mandate. And we are committed to delivering on bringing inflation back down to target.
So this is critical. Ed Yardeni publishing, I was literally on, you had the Gulfstream, sorry. I was coming out United slow motion. And Ed Yardeni published that, look, where nominal GDP is, we have plenty of room. Let's not fear it. Beth says raise interest rates. Let's raise them because we're nowhere near nominal GDP. Discuss that dynamic.
I think what I'm seeing is that there's not a lot of restriction in the economy. You see in businesses going out and raising lots of capital, trying to make new investments. That is good for growth. That can be helpful. But as Ed Yardeni points out, we've been seeing GDP growth coming in above what I think of as kind of long-term averages. When you have that kind of growth, that can put pressure on inflation. That can put pressure on people chasing prices higher. And what I hear when I'm out in the district is I hear from businesses that they're seeing their input costs go up. I was talking with a auto parts manufacturer in Northeast Ohio who was telling me he's seeing double-digit inflation in some of his input costs. He's trying to pass those on, but it's hard to get those increments to go through.
Do you actually see signs of froth in the market? Things that actually are excesses that need to be taken out?
That's not what I'm focused on from a policy restriction perspective. It's more about getting inflation under control.
But I guess that the question is, what exactly would raising rates do if it can't necessarily affect the price of oil? It can't necessarily affect the price of tariffs. And frankly, it's not exactly going to curtail AI borrowing if there is all of this backlog that we're seeing from the likes of NVIDIA and other semiconductors.
We have one blunt tool. We have interest rates. That is our main policy tool that we have. We have the balance sheet. We have our communications. That's kind of the full suite. But primarily we use interest rates. And so when I see an economy that, to me, seems like we've got inflation too high for too long, what monetary policy would tell you to do is to raise interest rates.
Do you think that interest rates are still the primary tool of this Federal Reserve, given some of the questions around exactly what Fed Chairman Kevin Warsh plans to do?
I think they're the clearest, most transparent, easiest to communicate tool that we have. I think we have a long history in knowing how raising interest rates or lowering interest rates can impact the economy broadly. The balance sheet that we have today is the confluence of a lot of different things that have happened over time, starting back in the GFC. It's, both some amount of QE that happened, so actually policy when you were at the zero lower bound. It's some amount of plumbing, of making sure that you've got ample reserves in the system, and it's some amount of market functioning purchases. So all three of those have sort of gotten us to where we are today. But we don't really know a lot about how changes in the balance sheet will flow through into the broader economy.
I know you won't talk about what other members of the Open Market Committee have said, but when you start doing a count of who said what, you get a pretty divided committee. And I'm wondering, we get the CPI report on September 12th. I'm wondering how close a call the next meeting is on the 16th, because we seem to be hanging on every inflation report that comes out. If we get a bad CPI, do you think maybe that moves the needle on September?
I walk into every meeting with an open mind, and I think my colleagues do as well. What's important to all of us is that we're squarely focused on the data that's come in, the stories that we're hearing from around the district, and making sure that we're setting policy to really support the American public and support growth overall.
Well, I got to ask you this question, too. October 28th, 5 days before the midterm elections, is that really, in effect, off the table because it's too close to the elections?
I will give you the exact same answer. Every meeting is, I walk in with an open mind, and every meeting to me is live.
I look at this, and you know, you were weaned at Stanford, you drank the John Taylor Kool-Aid. Are we slipping away from rules-based, and do we have a risk of an unanchored moment?
You know, rules are very helpful. They're helpful for giving you guideposts of how you should set policy, but they're not the only thing that I look at. They're one of many things that I look at. I look at the hard data that's coming in. I travel the district extensively to make sure I'm getting firsthand information about what's going on, because that gives me a better viewpoint as to what's happening down the road. And the rules are something as a guidepost that I can use to help think about.
There's any number of fossils, we'll say, and there's a number of fossils here assembled. We're just back to normal interest rates. Respond to that for the younger crew. It's like, OMG, 2-year, 10-year, 30-year, they're higher yields now, let's panic. I'm like, really?
Yeah, well, I share that same view. I mean, I grew up in the markets in the 90s, and in the 90s, you had interest rates between 3% and 6%, and that felt pretty good. I'm out in the district talking to people who say, gosh, 7-8% mortgages. My first mortgage was 17%.
Exactly.
Right? And so I think you have to normalize. You know, I think when we go back and look at the history, I think what we'll see is that period from 2008 to 2020 was the abnormal part, not this period where we're at today.
A lot of debt got incurred in that time, though, and housing prices are a lot higher. The U.S. now has $40 trillion of debt. How much does that compromise this argument that this may be the normal, but it isn't sustainable for this, at least government, and certainly the spending there?
Well, I have one job, and that's to make sure that we're delivering on maximum employment and price stability. That's the only thing that I'm focused on when I'm walking in the room.
Do you care about the 30-year yield today?
I do look at the 30-year yield. I look at the 10-year yield. I look at the full shape of the interest rate curve, because it does give me some sense of, again, where financial conditions are and how difficult or easy it is for businesses and households to borrow.
Do you think that the 30-year yield is rising because of fundamentals, or do you think it's rising in part because of this anxiety, this agita around the Fed's reaction function?
You have access to a bunch of amazing market commentators who can give you much better insights as to why it's rising than I can. But I look at a variety of factors that are driving it, and I think there's, you know, a confluence of expectations of what our policy is going to be, expectation of how persistent inflation is going to be, supply and demand forces at play. All of those, I think, are come into play.
President Hammack, have you seen any bears yet?
No, but my kids did yesterday. They were in Yellowstone, and they got me a great video of a bear kind of nosing around in the bushes.
Aww.
And I'm hoping not to see any more.
President Hammack, thank you so much. Cleveland Fed President Beth Hammack there. Really interesting to me how she is parsing through all of the data, saying, look, inflation's been too high for too long. We have to do something about it.
Yeah, I think it's a jumble, but what she brings is Wall Street cred. And there's so many academics here that have never enjoyed the bid walking away. And it's a very important place within it.
How many people have that kind of conviction right now, Mike?
Not many people have that kind of conviction at this point, but she, with her long experience in the markets, she's got some pretty good ideas. We're back with inflation to where we were when the war started, and that wasn't good enough for Beth Hammack and the others then, so we would expect it not to be good enough now.
Well, about 45 minutes until we hear from the big man himself. Coming up next, former Kansas City Fed President Esther George on a special edition of Bloomberg Surveillance on television and radio.
The last Q3, Q4 data for me last year was, I thought we certainly weren't restrictive and maybe even a little accommodative. So we've got work to do.
That was Kansas City Fed President Jeff Schmidt lining up behind some of the hawks that are increasingly sounding
Are there any
and being
doves
vocal.
here?
That's a good question. Is that going to be potentially the Fed chairman, Kevin Warsh himself?
To get beyond the speech, and as Mike nicely said, into October and the election and all that, the real question is the character and quality of dissent here, where lined up presidents and governors essentially school the chairman on where this Fed is heading. That's one outcome I don't think there's enough talk about.
Right now, markets are taking all of this in stride as we are marching toward that key speech in just about 44 minutes time with Fed Chairman Kevin Warsh. Right now, S&P futures higher by about 0.1%. If you take a look at the dollar, it isn't doing much right now, but it's lower by almost 2% since the last FOMC meeting. And when you take a look at 10-year treasuries, they have risen significantly in that period of time. Crude, of course, very much front and center. But Tom, the real story here is this question of CPI. At the last meeting, when they met in August of 2025, it was 2.9%. Today, we're talking about 3.4%. It has moved in the wrong direction.
There's no question that the vector and CPI is not cooperating critically. For example, Ethan Harris last night on LinkedIn shifted from being accommodative, maybe nothing will happen, to really saying the latest data links to some form of rate increase or the dissents around it.
So here's my question to a lot of people. What are they looking for? What is a good speech from Fed Chairman
Oh, there's
Kevin
too many
Warsh
answers
right now?
for that. We don't have that. Are we going 6 hours today?
Maybe.
Let's go 6 hours.
We might just do that.
We can get to all the punditry. You look, you love the punditry. I can't stand it. And the answer is the punditry meter's off the chart.
And it's also in Wall Street. Joining us now, I would love to bring in someone who has known this, who has shaped this event as the former Kansas City Fed President, Esther George. Esther, thank you so much for being here with us. What are you looking for today?
Well, when I come to this conference, I'm always looking for the substance of the topic, for sure. We all understand.
Really? Are you really looking for stablecoin right now? Is that really why you're here?
Always, always. Now, we understand that when the Fed chairman kicks off this conference, that everyone leans in and is listening, depending on what's going on at the time, what he or she has to say. And today is certainly one of those days.
How different is the mood here this time? I know that it's a little bit more lightly attended just because it's heading into G20, so there aren't as many international central banking leaders as have previously been here. Nonetheless, it does feel slightly different, with people wondering where the zeitgeist on the Federal Reserve actually is. How different is that?
Well, it's always different when you bring in a new Fed chairman, right? There is a transition here. This is his first speech at the podium. And so a lot of attention on what is he going to say, given the buildup to this, from the time he did his first press conference after the FOMC to what will he say here. And he signaled to us at the last press conference of the FOMC that he was going to talk about big questions. And so everyone's speculating on what are those big questions.
Okay, I'm going to be rude. I wouldn't ask this of the President Schmidt of the Kansas City Fed, but I'm going to you as well. The heritage of Kansas City is the agricultural Fed. We see wheat prices where they're going right now. We see the farm policy of President Trump is the Kansas City Fed steps out and says enough. How much are we going to see equality of dissent of presidents and governors given the data ahead? What's going to be the new character of the dissent, with great respect for the giant Wayne Angel?
Yeah. So I think when you come from the heartland, you are very focused, certainly on ag, but you are thinking broadly about what do these high prices mean for the long run in our economy. And that, of course, is the mandate of this institution, is to think about the long run. And so I think as people are looking at this inflation data, it is not turning in the direction that the committee had hoped. It is continuing not only to be sticky, but to press forward. And that, of course, requires a response. And what everyone's watching for is to say, what exactly is that response? Is it words, or is it an action with the tool that the Fed has?
Like the Supreme Court, where you know they're discussing, chit-chatting before an important case, do the dissenters talk to each other? Do they go back and forth and say, send a little email, I hate this guy? I mean, how does that work?
Well, you have every opportunity at the table to have a frank discussion about your views, to engage with one another. Has the New York
Fed president ever looked at you like, oh, Kansas City?
Of course.
Okay, I just want to be sure.
No, it is a great opportunity. I don't call it a family fight per se, but I think those decisions demand the kind of debate that this committee has at the table and has to, especially at times like this.
Do you think that most people agree that it was a mistake to cut rates by 75 basis points after the last FOMC meeting here at Jackson Hole, considering the fact we went from 4.5% to 3.74%. We've seen inflation by any metric pick up at that time. You do have people saying, okay, there are all these exogenous factors, but just looking at the numbers, it looks like we're further away from the Fed's ultimate mandate of price stability.
Yeah, for sure. I don't know if most people think that those rate cuts were a mistake. I might be in the camp of saying those were a bit uncomfortable to me, given the pace of the economy, the level of inflation at the time. And so I think it has raised now what we hear is, do we really believe policy is restrictive right now in the way that we did at the time those rates were being cut?
How do you think the Fed restores credibility? And I say restores credibility not when it comes just to a political overlay necessarily with Fed Chairman Kevin Warsh, but also the fact that they've missed their target for more than 5 years. And also when it comes to the fact that we're not seeing the dollar rally, even in the face of an oil shock that otherwise should be dollar positive. All of this kind of lends itself to this question of, do people really have faith in the Fed still?
Well, I think they do have faith in the Fed, but that is not an evergreen situation. It does require the committee to follow through and to take the actions. We've heard that in papers in past Jackson Holes, which is it is important to be clear with your words, but it is more important to be clear with your actions. And I think that's what people are watching for right now.
I just don't care. What a success. The Kansas City World Cup events, you were knee-deep involved in that, weren't you?
I was.
I mean, everybody's going MetLife, and it should have gone to Mexico. What was the experience in Kansas City? All the comments about you people getting it right, particularly with Argentina.
Well, Kansas City, the smallest market to host a World Cup ever. Certainly in the U.S. And so it was an important event for Kansas City, and I think they showed up well. The people of Kansas City and that region loved it, and I think our guests that came and base camp there did as well.
You got a new airport, you're booming, you've got, all the YouTube videos, moved to Kansas City and that, but at the same time, there's a worry about the depeopling of our agricultural farmland. Give us an update here. We talk about the fancy Wall Street people. We talk about, the businesses, as President Hammack was just talking about. What about agriculture in this nation 5 and 10 years from now?
Yeah, ag is such an important, it's a small percent of our GDP, but so essential to the underlying and you don't see that any more than you do in the heartland of the country. And so we have seen the demographics change over time, the consolidation in that industry, which has made it more productive overall, has really changed the dynamics in many of the small communities that populate that part of the country.
Esther George, thank you so much for being with us this morning. Esther George, who formerly led this event and had what some people are calling the Willy Wonka game of handing out the golden tickets because everybody wants to get this.
She would sit there lined up at the Pioneer Grow with their staff and the Kansas City dog. They would bring the dog here with them.
To try to curry favor with the former president of the Kansas City Fed. I want to take a look at where markets have been in the past almost 100 days. So it's almost been 100 days since Kevin Warsh was sworn in as Fed chairman. And if you take a look at two-year yields in that time, they have risen from 4.12% to today 4.24%. If you take a look at 30-year yields, they've risen almost 15 basis points. To me, this really highlights a question, especially given the rise that we've seen ongoing with the Russell 2000 and the S&P 500, a question of whether this is a feature of him or whether a feature of being overcome by events that have nothing to do with Fed policy.
It's a summation of events, and what I would say is it's not only the rate of change, but the rate of change of the rate of change, the second derivative. You got a jump condition in silver this morning. You got a, it's not a tension point in the 30-year, but we're getting there. First thing I looked at this morning was the French-German spread. I mean, why do you look at that? They look at that in Kansas City. I mean, it shows the fragilities that are out there within Europe.
Well, you can talk to that with, of course, we have a number of European officials coming on shortly. Coming up next, we've got Cameron Dawson of NewEdge Wealth, as well as, wait for this, Bank of England Monetary Policy Committee member Catherine Mann, who will come on and talk to you all about that French-German spread. From a beautiful Jackson Hole, good morning. This is Bloomberg Surveillance on television and radio. There is a cloud hanging over Jackson Hole this morning, both literally and figuratively. Good morning from Jackson Hole. This is Bloomberg Surveillance. Take a look at that. It really is just nestled into the peaks of the Grand Tetons to give us a sense of the mood as we await Fed Chair
It's going to be fascinating. Last night, for the first time in umpteen years, I actually saw lightning. I think it was after the third beverage.
Yeah.
So maybe I just saw it, but the lightning and the thunder last night was just stunning.
Yeah, stunning and potentially momentous heading into this speech. Right now, as the market opens, we do see everything pretty much flat except the NASDAQ down about 0.2%. When you take a look at 2s, 10s, and 30s, yields higher across the board, but not really doing much. Really, the fireworks will come in about a half an hour time. Watch the 30-year yield, 5.1962%. I did that just for you, Tom, because I know that you look out to the fourth decimal point.
It's a surveillance invention.
It's important, and right now we're seeing it just inflect a little higher, but really so much higher than it has been before.
Let me frame that out. I think, you're going to keep going here. Great. Eurodollar.
Eurodollar. Well, look, I know you think it's too much, but the Eurodollar is the other key indicator after what we hear from Fed Chair Kevin Warsh. How much credence do people have that this Fed, that this OFMC is committed to bringing down inflation?
And then Global Wall Street, we thank you worldwide on television and radio for tuning in. For Global Wall Street, they're going to go over to Euro Yen, take the dollar out, and just today there's a little bit of this in all the foreign exchange systems. I mean, Philippine peso is idiosyncratic out to a record low, but here there's
What's the technical for this?
This is the technical for this is it's febrile. Did I pronounce it right? I nailed it. Okay. But the answer is 30 minutes into this speech, there's a tension within the markets, as you correctly show in Eurodollar.
The anxiety, the angst, the questions. Who is Fed Chair Kevin Warsh?
Well, that's the point. There's no questions. I mean, there's not going to be questions in his speech.
Right.
That would be different.
It would be different, although it's unclear whether he would answer any of them. Who will answer our questions is NewEdge Wealth CIO Cameron Dawson, who does join us now. Cameron, great to see you. And thank you for zooming in to join us here in Jackson Hole. How important is this speech? Do you think it actually could make the difference for traders who have been a bit nervous, jumpy around the FOMC's reaction function?
Well, to Tom's point, there's no questions. So if Warsh wasn't willing to answer Mike McKee's question from the last press conference about what are you waiting for when it comes to rate hikes, we're not really certain that he's going to give guidance today. And I think the important thing to ask is whether or not there's been enough movement within markets to suggest that he needs to change his communication strategy. He has been very taciturn, but we have seen some movement in markets, but we don't really think it's enough. You effectively see the 30-year Treasury yield up a whopping 6 basis points since the July press conference. And if you look at things like inflation break-evens, they're still very much contained. So yes, there has been movement higher in bond markets, but this is not a bond market that is screaming for Fed Chair Warsh to temper inflation expectations because they're still sitting at 2.4%, meaning they still have faith, alarmingly, faith that the Fed will get back to its 2% target.
Kim Dawson, I know you start every morning looking at the BTMM screen on a Bloomberg, and you're looking at money market rates and that. If we see the 2-year come up, if we see money market rates come up, does that mean less cash will migrate to equities?
Not necessarily. We've never really considered this fungibility of money market rates needing to be the thing that drives equity higher. At the end of the day, you've continued to see money market balances climb to new trillions of dollars, and you've seen equity rallies. I think the bigger question for us is what happens to financial conditions as we move into a potentially new policy regime. Just 2 weeks ago, we hit an all-time, at least for this cycle, easiness in financial conditions. Look at the Bloomberg Financial Conditions Index. It was above where it was in 2021.
Yes.
This is reflective of very loose capital markets and just suggests that there is no evidence based on looking at markets that the Fed is even mildly restrictive and potentially very far from restrictive.
Cameron Dawson of NewEdge Wealth, thank you so much for being with us as the rain starts to drizzle down. There's
I feel like it's in Mary Poppins.
Well, I think we're just taking to London. It's funny who just dropped by.
It's just amazing.
Yeah, well, it feels like it. But Bank of England Monetary Policy Committee member Catherine Mann dropped by because the weather is just so familiar.
Right. Well, actually, this year, of course, it's been a drought in London, but you know, I'm trying to bring it back.
Bring it back. Yeah. So maybe we can import some of this. Catherine, thank you so much for being with us this morning. I am wondering how much how much you have other people on your side when it comes to being hawkish right now, because I know you've been a very vocal hawk. You tend to be really hawky and been very vocal about it. Is this something where you're finding a lot of compatriots here?
Well, there are three of us, I suppose, if you look at the last vote. But each discussion is about, what are we looking at? What does the research help us understand the way the economy works? And what are the implications for the monetary policy decision? So over time, those pieces are going to potentially come together with a different vote by the committee. We'll see.
You and I could have a 2-hour conversation on this. You own the phrase codependency with China and the United States. Your academics at Brandeis, your work at Citigroup, on your way to the Bank of England as the foreign restrictive serious member of the Bank of England. Okay, great. When I look at this, I'm looking at a restrictive set of events. What will happen if we raise interest rates in America?
Well, it's been very important, the spillovers from the policy in the United States as well as the macroeconomic conditions. These are very important ingredients to my financial conditions and also to the state of the UK economy. Right. So there's a lot of crossover, there's a lot of spillover, but I would have to see what the implications are for the financial conditions and whether or not those spillovers are appropriate for the economic conditions in the UK.
And the ballet of this, folks, is serious. We're talking here with a public official of the Bank of England, so she's going to give me a non-answer, so I have to rephrase a question to try to crowbar it out of Professor Mann. Codependency, China, U.S., codependency, the Chancellor of the Exchequer and the Bank of England or Treasury and the Fed. How in your study does the codependency work between fiscal authorities and monetary authorities?
Well, of course, what fiscal authorities choose to do or the certainty about what they might be doing has an implication for the business conditions, for the level of economic uncertainty, and that, of course, has implications for economic activity. It also matters for the financial conditions. The financial markets are going to be reflective of the prospects for fiscal conditions, as well as the uncertainty about what those fiscal conditions might be.
Right now, do you feel like central bankers have kind of had a changed vision? And I'm asking this in the respect that we're talking about interest rates to combat inflation that's being created by things that are far outside growth, that are far outside some sort of acceleration in economic dynamism. This is about oil supply shocks. Right. This is about tariffs. This is about AI build-out. Where does central bank policy really have a role when it comes to bringing down inflation tied to things that have nothing to do with interest rates?
Well, but those things that are events that are happening that are affecting the prices of goods and services, the inputs, ultimately do show up in the aggregate indicators of the CPI. And it has implications for the things that people buy in the stores. And so the manifestation of these supply shocks end up showing up in expectations, end up showing up being embedded in the prices going forward that firms choose to put on the shelf.
I guess to rephrase the question, to take Tom's trick, there is a feeling that you would have to put so much pain on an economy to bring in inflation, a disproportionate amount, in order to sort of curtail economic activity at a time where inflation's being driven by supply shocks. What's your take on that?
Okay, so you're assuming that the only channel through which monetary policy has an effect on the economy is through the demand side. There's an increasing amount of research, in particular at the UK and for the Bank of England, that my decisions can have an immediate effect on expectations of firms and households about what they think inflation is going to be. So I don't have to wait for a demand effect to see implications for my decisions on the CPI and especially on CPI expectations. And that, of course, is a key ingredient to the choices that firms' pricing strategies and what workers demand for in terms of wages. So I can have a quick effect.
What a wonderful heritage to have Americans in the Bank of England. There's been a real esteemed set of academics that have gone over there with a different perspective. What have you learned about the reality and impact of dissent at a more fractious Bank of England versus all the Greenspan heritage of the Fed, where we're all on one page, but we're really not? What have you learned?
So I think we can't really compare the Greenspan, everybody kind of getting together, and the kind of what you're saying fractious. I would say more of a debate-oriented Bank of England. The time period is different. The macroeconomic environment is very different. Greenspan didn't have to deal with the same amount of supply shocks that we have had to deal with. And so that debate, I think the other difference is the extent to which research informs policymaking decisions. And I think that research, because the environment is different, because supply shocks have become so much more important, because the great moderation is behind us, that research is informing the policy decisions.
Does Chairman Warsh have to reach out to the hundreds and hundreds of PhDs at the Fed today?
I think they are his key ingredient.
But he's told him he wants a task force because I don't like the research at the Fed. Are you on a task force?
I'm not on a task force.
I could see you on a task force.
Well,
that
maybe
would be something.
a task force to get the kids to college.
Right,
I am
right.
curious, though, to what degree you think it's important for Fed Chairman Kevin Warsh to actually give some sort of reaction function, to actually answer some of the many questions right now in markets?
Well, what I do and what determines my reaction function, how I communicate it, is I tell, I give speeches, right? We have our 200-word paragraphs. What are the data that I'm looking at? It's all very disaggregated. It's a key ingredient. You look at the disaggregated data, not the aggregated stuff. Secondly, you have all this research that's telling us how is the world different and how does that data translate into how the world is different, how the behavior of the economy is different, and then all that adds up to my decision. I call that, showing what your reaction function is.
Are you going to be going on the hike this afternoon?
Depends on how much it's raining, I guess. But
in
principle, yes.
Yeah, well, I hear it did last year, and people are expecting it to as well.
This was successful. We got through it without talking about Harry and Meghan. It should.
Well, until now, it was basically you're going to try to job on this in. You want to get her views on it?
I'm not going to get an answer out
Bank of England Monetary Policy Committee member Catherine Mann, thank you so much for being with us this morning.
Thanks very much.
It's interesting to see who's here and who's not here. All the Fed officials are here, Tom, except for one, and that would be Jerome Powell. Governor Jerome Powell did not come, and partly out of respect for the Fed chairman, because he doesn't want to complicate the issues.
Right.
He is perhaps hiding behind the podium, just like he said he would.
I sat out front, just to give you a picture of this. There's an 8-foot grizzly bear out front of where everybody marches in. And, of course, McKee's in the room because he's special, and I'm not. I've never had an invite because McKee has to be in the room. And so I'm sitting there watching the beauty list.
Come on, get it out.
The beauty list go by, including Catherine Mann's entourage last night. And the answer is I'm really impressed with how Kansas City has a cross-section of young, esteemed academics and the ancient academics as well. It's a hell of a turnout for this speech.
Yeah, and right now it is more important than ever to understand the drivers of inflation, the drivers of currency differentials. And coming up next is someone who's been studying it and who is presenting at this meeting, Professor Eswar Prasad of Cornell University, on the dollar, the role of it. We will, of course, have one question on stablecoin, but don't worry, that's not what people are looking for right now in any way, shape, or form. From beautiful Jackson Hole, this is Bloomberg Surveillance on television and radio.
I think we need to put some restriction into policy, and so I believe it's time to act for us to do that. The longer that we wait to get inflation under control, the more pain is felt by everyday Americans and the more difficult it may be for us to ultimately get it back down. What I'm seeing is that there's not a lot of restriction in the economy.
That was Cleveland Fed President Beth Hammack. Are there any doves left? I think that's a good question, considering the fact that we had Beth Hammack and Catherine Mann, 1-2 punch of hawks here in Jackson Hole, Wyoming.
I think it's an important insight, and the answer is what defines a dove now. And, in many of the interviews I'm doing, I've had houses talking about 2 and 3 rate cuts out there somewhere. To me, we're just more data dependent than we've ever been.
And the market's more data dependent right now, and anything that the Fed Chairman Kevin Warsh might say, the data coming out of his mouth in just about 14 minutes time right now. A lift to the S&P after blockbuster earnings from Nvidia, up 0.2%. The euro dollar not doing much. The euro just losing a bit, about 0.1% versus the dollar. The dollar ascendant this morning. We'll talk more about whether that's something more of a trend or perhaps a blip. And 10-year yields higher. Watch this space, and particularly the 30-year yield field ahead of the speech, considering the fact that it has risen significantly since May 22nd when he was sworn in, and a question around just how much this has to do with agita around the Fed's reaction
I want to
function.
sell this, folks. Everybody's underplaying it. Later this afternoon, Wall Street Time, Lisa Abramowicz with Kristalina Georgieva, and I'm sorry, into the Bangkok meetings. This is a really important conversation of a world turned upside down.
A question about inflation dynamics, a question about trade tensions, a question about fragmentation, and a question about what central bankers' roles are in all of this, especially given the confusion around AI and around, frankly, currency dynamics, which is why I think we really need to get into the conversation with the guests that we have on set. Cornell University professor Eswar Prasad, one of the preeminent scholars when it comes to doom loops, when it comes to the dollar. Eswar, thank you so much for being here. I know you are presenting a paper about stablecoin and how potentially could increase demand for the dollar. Zooming out the context for this, there is a feeling that the dollar has lost some clout when it comes to being the reserve currency in the world, and you have seen it not react as much as people would have expected in the response to shocks. Would you say that that is consistent with perhaps some of what you're seeing?
So, Lisa, there is very good logic to the notion that the dollar should be getting bounced off its pedestal because of, weaponization of the dollar, macroeconomic policies in the U.S., the policy volatility coming out of here. The reality is that the dollar has lost some of its safe haven status. Its share of foreign exchange reserves has gone down. The convenience yield, the sort of premium associated with dollar privilege, has gone down. But the other reality is that the world does want safety. Private investors in particular, rather than central banks, are now looking for safety in the rest of the world, and they aren't finding too many other places to put their money. So we still have enormous inflows into the U.S. Equity markets and other financial markets. So there is this sort of tension here. On the one hand, the U.S. remains a dominant financial market, the one that everybody still comes to, but the sense that the U.S. is not as safe as it might have been once upon a time, that is certainly true as well.
And your paper talks about how stablecoin could generate demand for the dollar that just increases its status as a reserve currency. Do you think that there is a tell in the fact that the dollar has weakened since Fed Chairman Kevin Warsh has taken over on May 22nd? Or do you think that that is coincidental because of some of the confusions and turmoil in global markets?
So I look beyond these short-term movements because there are macro factors and policy factors that can drive these in the short run. But the paper that I am presenting here is more than just about stablecoins. Stablecoins already exist, so they are the sort of leading edge of financial innovation. But the key aspect of financial innovation is that it is going to reduce frictions to cross-border asset trade. It's going to make it much easier for firms to raise money in capital markets worldwide. It's going to make it much easier for investors to acquire assets worldwide. And I mentioned earlier that private investors are the ones who are really acting very forcefully right now. If you make it easier for them to get foreign assets, what assets are they going to be looking to? It turns out the answer seems to be dollar assets. So it's in that sense that this combination of financial market depth in the U.S. and financial innovation that reduces frictions to cross-border asset trade might end up reinforcing the dollar's dominance. In principle, it should be creating a level playing field across currencies. But in fact, we might see an opposite outcome.
Okay, I'm going to frame this. I have Kenneth Rogoff coming up later, giving a speech, I believe, at your lunch today. To have Eswar Prasad and Ken Rogoff with us is joy. How much is this banker totally focused on his America in his White House? How much is Chairman Warsh missing that he's central banker of the world? I got the idiosyncratic Turkish lira gone. I got Philippine peso out to new weakness. I got every central bank calibrating rate increase or not, etc. How much are we missing in our American selfishness, the rest of the world right now?
So I think it's very important to recognize that what the Fed does, sets a benchmark for the rest of the world. But what the Fed does have a spillback effect onto the U.S. as well in terms of what the market reactions of other countries are and what other central bankers' reactions are.
I don't mean to interrupt, but this is too critical. Is that part of your doom loop? And that the rest of the world looks at, we're focused on Lisa Cook or we're focused on this, whether the Red Sox can catch up with the Yankees. It's all baloney. It's like we have forgotten about the rest of the world's central banks.
Every central bank has only domestic mandates written into its charters, not foreign mandates. But the reality, Tom, is that we live in an interconnected world right now. If the Fed does not, raise rates, that is going to have some implications for inflationary prospects in the United States, and that's going to have implications for the rest of the world's willingness to acquire assets in the U.S., and that ultimately will either make Kevin Warsh's job harder or easier. So it's very hard to ignore the rest of the world's reaction to what the Fed is doing, even if you don't directly include that as part of the Fed's objective function.
So you don't necessarily see this as a fragile moment to restore Fed credibility in order to foster more faith in the U.S. currency and U.S. assets. That seems to be sort of underpinning what you're saying, that it's not as at stake as some people might say. Is that correct?
I see it as a hugely fragile moment, Lisa, and there are two reasons why. Number one, what we would like is to have a more multipolar world where there are multiple currencies that are built on strong foundations of deep and liquid, well-regulated financial markets and institutions. So you have more balanced currency competition. No country can go, wild with its policies. The other possibility is that because of weaknesses in the rest of the world, you end up with the dollar becoming even more dominant despite all the policy dysfunction that we see here, perhaps not in monetary policy, but in other aspects of policies. So we might end up in a world that becomes very, very fragile. If it is dollar-centric and the U.S. is not, is having erosion of its own policy frameworks and institutional frameworks, that's bad. If we end up with a world where we don't have good multipolarity, where we have fragmentation, and there is no trusted anchor that everybody can hone in on, that's a very fragile world as well. So I think it's a very dangerous moment.
What are you hoping to hear in just about 6 minutes' time from Fed Chairman Kevin Warsh?
I think we all want clarity about the framework, about exactly what the triggers are likely to be. And of course, as a central banker, you need to leave yourself some room to maneuver. But as I mentioned earlier, what the Fed does, how it operates monetary policy, is really the benchmark for the rest of the world. So at some level, the work that the committees that Kevin Warsh has set up that are working on these issues are really crucial, not just for the Fed, but for other central banks around the world. That's why we have so many central bankers here. They want to hear what the Fed is going to do.
The doom loop. Did you sell the movie rights to Hollywood?
I wish I had, Tom.
It sounds like a movie.
Who would play the main character? Who would be the main character?
I think DiCaprio, it's something he could pull off.
The doom loop.
The doom loop.
Will it get bombed by a major economy? Eswar Prasad, thank you so much for being with us, a Cornell professor who is going to be presenting his paper, The Doom Loop. I actually think that it could be a really good plot. We could really dramatize.
The book is on my coffee table at home, right next to How to Get Your Teenager to Empty the Dishwasher. And it's just a fabulous book.
Sounds like a thrilling reading list right now. It definitely feels like not necessarily a doom loop, but you feel the tension in the air as we await the Fed speech that we are going to get just moments away. Joining us now to talk about it, former Fed Vice Chair Rich Clarida. Rich, thank you so much for being with us. We've talked a lot about whether Fed Chairman Kevin Warsh will err on the side of being hawkish in order to rectify what some people would say is a slight policy error, or at least a lack of clarity at the last meeting. What's your view on this?
Well, we'll find out soon enough. Thank you for having me. At the press conference in July, he indicated he might talk about the big questions, the task forces, maybe the here and now, so we may get a bit of each. But I do think it's important, Lisa and Tom, since we do hear from Beth Hammack and Neil Kashkari and Lori Logan and others about their outlook. I think it is important today that we hear something from the chairman about his framework for thinking how we get inflation back down to 2%.
Does Chairman Warsh need a Richard Clarida? Do we need a monetary policy heavyweight that can spell dynamic stochastic general equilibrium theory? Does he need a Clarida to move forward?
Look, he's surrounded by incredible people, many of whom I know and worked with, and so I don't think he needs a Clarida, but it was an honor to serve for 4 years. I'll leave it at that.
I'm wondering, Rich, right now a lot of people are talking about stablecoin, or pretending to at least. That is the headline number or headline topic here in Jackson Hole. How divorced are the academic topics from usually what people talk about in the room when they're looking for a guide on monetary policy?
Well, I think getting stable coins right is important for the next 5 or 10 years. And so I applaud Kansas Citi for being forward-looking. But I think, as your question suggests, I mean, there's a lot of focus, as there should be, on the here and now. And traditionally, Fed chairmen have used Jackson Hole as a preview of coming attractions. And so I think I and you will be interested to see if Chairman Warsh takes that opportunity today.
Rich Clarida is sticking with us to talk with us after we hear from Fed Chairman Kevin Warsh in about 2.5 minutes' time. Really compelling moment right now in about the 100-day mark for this Fed Chairman.
Major shout out to Dan Torrens and all of our production teams in Jackson Hole in New York. The conversations we're having, I think, really identify for a global and American audience, this is way more than the punditry of what's the Fed going to do at the next Fed meeting, the international ramifications, and just simply what's the plan, I think, is the heart of the matter. This guy has stumbled a couple times. Even his supporters would say that. And he's got to right the ship here and say, in his own way, this is the plan forward.
Yeah, what is the plan? What are we looking at? What are we going to use as measures of both inflation? Is an inflation target as important as it has been in the past?
This inflation series, I mean, Beth Hammack, folks, at Cleveland Fed, 1983, they revolutionized this. Powell liked the Dallas trim mean. There's 14, it's like Howard Johnson's. There's 28 flavors. Somebody, McKee likes pistachio. The answer is, yeah, we got to get an inflation series we believe in. Right now it's PCE. Maybe it'll be new PCE. Who knows?
Michael McKee sitting by with us as we await this speech. It should be starting in about 1 minute and 20 seconds. Any idea how long it's going to be? Any idea what's in it? Or is this the great unveil that we're going to get?
It's the great unveil. The reporters have...
You haven't had an advance copy?
Yes, we've had an advance text. So you'll see the headlines in about 1 minute on the Bloomberg terminal and certainly on our screen. And I will try to give you something before Kevin Warsh starts speaking. But I think that people are going to find it a very interesting speech. And it is not an 8-minute speech, I can tell you that.
All right. Well, that's good to know. I mean, maybe we'll actually get something. Look, there are so many bigger questions about whether interest rates are the first and foremost tool that the FOMC should be using to control inflation, whether inflation is something that can be watched or whether it has to be targeted in an aggressive manner after more than 5 years above target, and supply shocks, questions about whether oil prices are significant for them to have to go after, whether artificial intelligence is inflationary or disinflationary, something he's talked about on several occasions.
I think those distractions are there, and maybe he'll touch on them. I think he'll touch on the tax force, but much more, as you have said eloquently, what's your damn reaction function? I mean, that's the heart of the matter.
Yeah, and a lot of people are saying that reaction function and forward guidance are not the same thing, so you can give a sense of what you're looking at. I think there are other people saying it's sort of a slippery slope if you give a sense. Right. We are getting some headlines right now from the speech. Let's give them to you. Kevin Warsh saying that we have work to do if inflation is not moving to 2% with speed. He said that the Fed's 2% PCE objective is a firm, fixed target. Let's head over and listen to Fed Chair Kevin Warsh right now.
Thank Jeff Schmidt and his team for the incredible hospitality. Everybody here is in debt to you and to your colleagues here at the Federal Reserve Bank of Kansas City. Jeff, our thanks to you and your team. Now, he and the other planners here have some recreation options lined up for later today. I'd advise you to be very careful with your choices. As I learned years ago, you can take 2 different kinds of hikes on the trails around Jackson. I can sum up my hikes with former Vice Chairman Don Cohn with 2 words: I survived. These steely marathon death marches revealed a sign of Don that I was not ready for. But there's another kind of hike. This one was with former Chairman Ben Bernanke, another dear old colleague. With Ben, it was a much more leisurely pace, an easy stroll along the wandering trails of the Rockefeller Preserve. So before setting out today, my recommendation is do a wellness check. Ask yourself, is this a Cohn day or a Bernanke day? The best thing about this gathering is that it helps us all get out here to the mountains and clear our minds and think straight about our world and our time. For me, it feels like the right place and the right audience for a real engagement with the ideas that matter most. Innovation, as Kristen mentioned, is the conference theme. And I believe the public and the markets understand that innovations in the conduct of Fed policy will help deliver price stability alongside full employment. So here's a quick overview of what I'll cover in my remarks this morning. You can call it an outline, you can call it a trail map, but please just don't call it forward guidance. First, I'll touch on a few of the longer-term questions we're asking at the Fed about the latest general-purpose technology, AI, and where it might take the economy. Then I'll reflect a bit on the practice of forward guidance and the interaction between the central bank and financial markets. Next, I'll present some of the key principles that I believe should guide the conduct of monetary policy. And finally, I'll give you my assessment of what's happening in the economy. So first, I think we should try to prepare a bit for future policy conjunctures. With the unchanging picture of the Tetons as our backdrop, we are here to survey an economic landscape that is anything but static. It wasn't so long ago, including in rooms like this, in the run-up to the crisis of 2008 and over the decade that followed, when economists and policymakers were speaking of secular stagnation, speaking of a global savings glut. It was a widely held view that an excess of capital would sit on the sidelines for a very long, long time, because there just wouldn't be enough compelling investment opportunities. All the good stuff, you'll recall, had been invented, so growth would be low and slow. Well, times sure have changed. We've come to a hinge point in history, to borrow a phrase, a framing from my former mentor, George Shultz. To cite the clearest example, progress in AI, the 80-year-old name for the newest technology, has been faster even than its evangelists predicted just a couple of years ago. The potential for substantially higher growth is on the rise. Ever-expanding pools of capital pouring into AI-related infrastructure of all sorts. A kind of super Moore's law seems to be playing out. Scaling laws, too, are changing both the method and speed of innovation. Capital and labor have combined to create large language models at the heart of AI. Users buy tokens to gain access to these models. Reports put annualized token sales for the two leading labs alone at more than $100 billion, an increase of 500% from just 12 months ago. We at the Fed, we watch all this attentively. We recognize that AI is a new variable, potentially a new factor of production that will have consequences both for the economy and for the conduct of monetary policy. It opens up some major lines of inquiry. Will the application of AI cause a significant sustained rise in productivity across the economy? If so, when? Will token usage be complementary or competitive to labor? Will the next generation of AI models demand even greater capital intensity too? Or will the models themselves help devise a capital-light solution? Among the other yet unknowns is the resulting market structure. Who gets to make the money? It's not obvious where the returns on capital will land or on what timescale. Early on, how much of the surplus goes to owners of scarce assets, the AI labs or chip makers or energy producers or cloud providers? Over time, how much of that value accrues to businesses and consumers? And importantly, what are the implications for workers and for the employment side of the Fed's mandate? Likewise, we don't yet know the equilibrium price of the tokens that give access to these models. Might there be a heterogeneity of tokens such that growing sums will be paid for the access to the best models, those at the frontier? Will token prices for older models fall to the level of their marginal cost? Well, we'll be thinking through these matters with the help of a task force on productivity and jobs. My early check-ins with the leaders of that task force and the rest have been very encouraging. To be clear, though, their recommendations will come later and have no bearing on decisions we make in the current policy conjuncture. But I believe that for future policy challenges, This intellectual investment today will leave us much better prepared for tomorrow. Next, let me say a word about forward guidance and its substitutes. As our task forces go about their work, as you might know, I'm not waiting to introduce innovations at the Fed to help make us fit for purpose. To highlight one example, I've set out to change the form and function of the Fed chairman's so-called forward guidance. You might know about my longtime discomfort with early pronouncements of future policy decisions. I much prefer another path, and now we'll make the case for it. Transparency in communications about future policy decisions is not an end unto itself. Communications must be in service to the Fed's paramount responsibility. And what is that? That's getting policy right. Forward guidance as a regular practice was adopted by my colleagues and me during the global financial crisis. It was essential at the time, and we introduced it with much fanfare. But as with other legacies of crises past, I believe the practice has outstayed its welcome. In normal times, the role of forward guidance should be limited and circumscribed. Otherwise, it risks creating ambiguity in the name of clarity. Oversharing policy deliberations and overcommitting to future decisions can lead markets, businesses, and households astray. And I believe when policymakers make quasi-commitments on interest rates throughout the cycle, we inhibit our own freedom to make the right calls when it's time to decide. To get policy right, we also need to get the relationship right between the central bank and financial markets. The Fed needs clear market signals, as unfiltered as possible, from market internals, from the level and change in asset prices across sectors, the prices and trading volumes of Treasury securities, the foreign exchange value of the dollar, the cost and availability of credit, a broad set of commodity prices. These and other indicators should inform the Fed's near-term outlook on economic activity and inflation throughout the business cycle. They should also reveal the state of broader financial conditions and the risks and uncertainties of the financial cycle. At the same time, market participants themselves should be tracking real information about the real economy. They should draw their own conclusions, form their own expectations on things like output and employment and inflation, and they too should stay sharply attuned to risks. In my view, the Fed should be humble and never naive. The Fed plays an essential role in the economy and markets. Our tools are powerful. We determine the path of short-term interest rates, and market participants will always try to anticipate what we will do next. But we should not indulge a regime in which market participants are looking primarily to the Fed for their next trade. The economic literature has long described the distorting effects, what it called the Hall of Mirrors problem. If markets rely materially on the Fed's guidance and the Fed relies on market prices, we're more likely to be blinded to new developments, more likely to be caught unprepared, and more likely to commit errors in policymaking. Now, perversely, market participants are unlikely to bear the biggest costs of the Hall of Mirrors problem. The most serious harm is likely to befall those without any financial assets. If the Fed gets inflation wrong and judges the economy wrong, who gets the worst of it? Not the financial high flyers. Hardworking Americans are the ones left to deal with inflation that's too high or jobs that suddenly appear less secure. So, if forward guidance is ill-suited to normal times, how about the new Fed chief commits at a meeting just like this to some explicit reaction function? Surely he could tell us his interest rate path, if, say, the data were to come in hot or cold. Well, I wish our understanding of the economy were so precise as to provide a mechanical, tried and true answer, that some simple function, like a Taylor rule, could be rigorously relied upon. But our knowledge just does not extend that far, at least not yet. And other factors most relevant to the proper conduct of monetary policy, they change over time. Providing forecasts to illustrate the Fed's reaction function works better in theory than in practice, better in the lab than in the field. I am not alone in noticing that forward guidance in 2021, to cite just one example, might well have slowed the policy response to high inflation. In my term as chairman, my colleagues and I will endeavor to construct more reliable models, more robust rules, and we'll do this knowing that accuracy in forecasting is still just an aspiration. With so much changing so fast in our geopolitics, global supply chains, technology, it's wise to be modest about what we can and cannot know as we sit here today. In the same spirit, we should receive the full range of ideas on matters that may inform the Fed's monetary policy discussions. If the aim is optimal decision-making, and it should be, we should not crowd out views on the economy. How then to chart a better path to policy? In the balance of my remarks, I will share with you some key principles that guide my thinking on the appropriate conduct of monetary policy. And then I'll offer my promised assessment of the economy. So let's turn first to principles. First, I've noticed in this line of work, yesterday's news has a way of getting mistaken for what's happening right now. The challenge is to know the difference. In other words, we must interrogate reality. Make sure we're not setting forward-looking policy based on stale or inaccurate data. Nor should we rely on isolated data points. Trends matter most. The Fed's a decision-making agency. We make choices amid uncertainty, and the data upon which we draw must be relevant, contemporaneous, accurate, and as actionable as possible. Second principle. The Fed's actions are intended to ensure that the aggregate demand side of the economy is broadly consistent with aggregate supply. However, all we observe directly is activity. We never see and can only infer what's really happening on the supply side. Hence, evaluating the current and expected balance between aggregate supply and aggregate demand is imprecise. Third principle, there should be no misunderstanding. The Fed's price stability objective of 2%, as measured by the PCE price index, is a firm, fixed target. Let me be equally clear about another aspect of this objective. Price stability is not self-executing, nor is inflation necessarily mean reverting. It's the Fed's job to deliver stable prices, no excuses. Fourth principle, the Fed also bears responsibility for maximum employment. Achieving both sides of our mandate over the medium term is not an either-or proposition. I do not believe the Fed's dual mandate works at cross purposes. After all, high inflation itself is very harmful to economic prosperity. Fifth principle, short-term interest rates are the predominant tool to achieve the dual mandate. Unconventional policies to spur economic activity may suit genuine crises, of which we all have much experience, but they should otherwise be used sparingly, if at all. Sixth, money matters. I know it's not fashionable these days, but my view is that money has something important to do with monetary policy. We should pay attention to money created by the central bank and money that comes from the banking and financial system. It's true that financial innovations, the subject of this conference, and other factors alter the mechanics that link the monetary base, the velocity of money, and the broader economy. But that is scarcely a reason to ignore the ultimate effects of money on financial conditions and prices. Finally, a quieter Fed, a more purposeful Fed in its communications, is better able to meet its objectives. And we can be held accountable for delivering on our remit, the only true test of our credibility. To borrow a line from General Chuck Yeager, at the moment of truth, there are either reasons or results. So having heard a little bit about AI and general purpose technologies, having heard a little bit about the next policy conjuncture, a little bit on principles, let's turn to the economy today. Given those principles, how do I read the economy? What's really going on outside the window? It's a little ironic, there are no windows in this room, but there are big ones at the Federal Reserve. And we've been using those in my first 100 days, and I expect we're going to continue to use those in the period right ahead of us. Now, you may have read in the July minutes the unanimous view of the FOMC. Labor markets were stable, output solid, but inflation remained too high. A good majority of my colleagues and I thought the wiser course was to await new information in the intermeeting period, especially given possible developments in supply chains, investment flows, and geopolitics, before deciding whether a change in interest rate policy was advisable. And we expressed our joint readiness to act as circumstances require. For my part today, as we sit here, I'm impressed by the overall performance of the economy, which appears to have strengthened. One indicator of strength is how well an economy holds up under stress, how well it holds up under shocks. On that score, both Main Street and Wall Street have been remarkably resilient. Several other observations. Business Capex is rising rapidly. The four-quarter change in investment in equipment and intangibles has been around 9%, its highest growth rate since 2021. And more than half of the Capex growth can likely be ascribed to the build-out related to AI. What about profits? For the firms in the S&P, profits have grown more than 20% over the past year alone. Profit margins are quite elevated relative to history. Overall equity and market volatility, quite low. We're staying keenly focused on market internals, watching performance across sectors. Expectations for both growth in Capex and corporate earnings are running quite high. I continue to watch the change in the growth rates, the second derivative. The follow-on effects on asset prices, business confidence, consumer incomes and spending are equally important to gauge. Credit spreads on corporate bonds and leveraged loans are near the low end of their historical averages, and issue volumes this year quite strong. Looking beyond fixed income markets to the banking business, in the July so-called SLOOS survey, banks tell us that standards for C&I loans are on the easier end of their historical ranges. That helps explain their growth that we've seen this year in these loans. In my view, credit and loan markets are showing few signs of policy restraint. Now, certain sectors, like housing and agriculture, are showing strains. But on balance, I would be hard-pressed to describe broad financial conditions as restrictive. Real consumer spending has been healthy despite these shocks, increasing more than 2% over the past 4 quarters. If you combine consumption with the brisk investment we talked about earlier, private domestic financial purchases have also risen. These purchases have increased at a pace of nearly 3% or so far this year. That's a measure that typically carries more signal than GDP. The trend here, too, positive. So on the employment side of the Fed's dual mandate, our country's doing well. Labor markets are quite stable. The jobless rate at 4.1% remains low by historical standards and hasn't changed much in a couple of years. Unemployment claims on a 4-week moving average, an empirically robust real-time indicator, are near their lowest level in decades. In my view, the relatively low turnover in today's labor market is partly a result of the significant rematching between employers and employees that happened in the post-pandemic environment. But when labor supply is barely growing, monthly job gains are naturally going to run low. There are always areas of concerns in the labor market. For example, among recent graduates. In general, though, people who want to work, by and large, are holding or finding jobs. They may well be concerned about future labor disruptions, but as of now, I believe the labor markets are broadly consistent with full employment. But on the price stability side of our mandate, the numbers are more concerning. The Fed's preferred measure of inflation, the one I talked about earlier, the 12-month change in the PC price index stands at 3.7%, with the 6-month change a little above 4%. The comparable measures from the CPI index are also elevated, as are core measures both of PCE and CPI inflation. And none of these measures are perfect, but they all tell a similar story. Inflation is running above our 2% target. So the Fed's predominant focus right now should be on prices. So what's our job? The job for policymakers is to capture underlying trend inflation. Easier said than done. We want to gauge whether underlying inflation is rising, falling, or seems to be stuck in place. We also want to understand not just the direction of travel, but the speed. Each of these broad inflation measures have fallen significantly from their highs of a few years ago, but progress over the last couple of years has been more modest. And while this summer's PCE and CPI readings were better than expected, they do not tell me that underlying trends have meaningfully improved. The data also show moderate wage growth, but in my view, in tracking underlying inflation, wage growth has not proven a reliable indicator of future inflation for a very long time. So to try to gauge underlying inflation, I want to tell you about a couple things I've always looked to. I find it instructive to disaggregate the 199 individual components of the PC price measure. Over the last 12 months, 54% of goods and services in this basket showed price increases above 3%. This is well below the post-pandemic highs of about 77%, but it remains well above the level of 32% in a couple of the decades that preceded the pandemic. Looking over just the last 6 months, the conclusion is similar. 49% of goods and services in the PC basket showed price increases above 3%. Again, this is well below the post-pandemic highs, but still elevated, quite elevated. The recent rise in overall commodity prices also bears watching. What we need to judge is whether the trends we see indicate upside inflation risks. Now, it matters, too, whether the inflation readings of the past 5 years have seeped into expectations. The good news is that measures of inflation expectations in the medium term, by and large, look stable. And inflation compensation measures from the swaps market send a strong and similar message. Especially in light of recent developments, it's a credit to the Fed as an institution, consistent with the best of the Fed's traditions, that market prices show confidence that we will deliver price stability. And I can assure you, they're right. The thing about market measures of inflation expectations in economic history, I know some economic historians in the audience, is they all tend to look really strong and durable until they don't. These expectations are not pushed around easily, And right now they are very well anchored, but they must be closely minded. And it's the Fed's job to make sure that inflation expectations do not get unanchored. Now, there is one signal nobody can miss. The responsibility for 65 months of sustained elevated inflation sits squarely with the central bank, and that's where it belongs. So here is my standard. We must be confident that underlying inflation is moving to our objective, clearly and at sufficient speed. Otherwise, we have work to do. That's our job, that's our mandate, and that's our charge to keep. So I've covered quite a bit of ground in the last 25 minutes or so. Let me see if I can conclude this way. I stand here today committed to a discipline, not a decision. My Fed colleagues and I are hardly the first to hold these positions in a time of great consequence. We are determined to redeem the time by doing our very best work. For those of you that know us, you'll know the following is true. We take our responsibility seriously, with humility and with resolve. We know so much depends on the choices we make. Sound monetary policy helps households and businesses to prosper. When carried out effectively, it broadens and deepens the momentum of our economy and helps to secure America's leadership in the world. And I know that our country needs us to think carefully and act wisely, perhaps now more than ever. It's a tremendous honor to serve once again at the Federal Reserve. I'm truly grateful for the encouragement, good counsel, and the warm reception I've received in my first 100 days from my colleagues. I'm also honored and grateful for the views that I've gotten, solicited and unsolicited, from so many of you in this room. For that, and for your kind attention this morning, I say thank you. Let's get on with the rest of the program.
That is Fed Chair Kevin Warsh wrapping up his Jackson Hole remarks. This is Bloomberg Surveillance on television and radio, live from Jackson Hole, Wyoming. If Fed Chairman Kevin Warsh's goal was to be hawkish, it was Operation Success. He really did say the key line at the end: here is my standard. We must be confident that underlying inflation is moving to our objective clearly and at sufficient speed. Otherwise, we have work to do. That's our job. That's our mandate.
It was very Warsh speech. I like what Ira Jersey said within the Bloomberg terminal feed, that this is pretty much a carry forward from what we heard before. But I know you're going to jump into the data check here, and I think we need worldwide for everyone to sit on the data check, particularly within bonds and foreign exchange.
Let's start with bonds. What you are seeing is a response to a hawkish message, which is at the front end of the yield curve. Yields significantly higher. You are seeing yields for the 2-year up by more than 5 basis points at one point. Now it's up 7 basis points, almost 8, 4.31%, with this feeling that this Fed chair was prepared to hike rates. 10-year yields up just a basis point, 30-year yield down by 2 basis points. This is the yield curve flattening people were expecting. Watch the long end of the yield curve, and that flattening is coming in with a vengeance. The 2s-10 spread seeing its biggest compression going back a month.
What I know is Kate Moore's going to come on with us here in a bit, and what she's going to be doing is they got to do twist and shout at the party when they're dancing here. This is an Operation Twist. This goes back to John F. Kennedy, and literally they took the phrase twist from Chubby Checker when he was doing, I'm serious, twisting twist here. You've got that 8 basis point move in the 2-year, the 30-year bond goes the other way, but critically for me, the real yield popped back up, not out to some angst-driven level, but again, we reset the restrictive moment based on his comments.
You know, what he said, there is one signal nobody can miss. The responsibility for 65 months of sustained elevated inflation sits squarely with the central bank, and that is where it belongs. It does seem as though there needs to be some kind of backing to those words. And right now it seems like Fed Chair Kevin Warsh is on the hawkish team, and you're seeing that bleed into market expectations. You aren't seeing that much of a reaction in equities, and this is notable. Yeah. It's not coming with necessary restrictiveness in the equity sphere. When you take a look at the S&P, NASDAQ, and Russell 2000, all of them are lower, but not a significant sell-off. The Russell 2000, as you would expect, seeing the significant decline, 0.7%, as it is more interest rate sensitive. The other sectors, not so much. The NASDAQ actually had been lower more earlier this morning.
Yeah, I mean, equities play into it, but I think they're also going to play into just getting to the weekend and getting on from the NVIDIA blowout in that. I would again focus, as we had with Eswar Prasad, on the global ramifications here, and I think it's really key. I got a quote here. I'm going to bring this up. I don't know, Ann, if you have it in New York City, but to me this was really telling. Finally, a quieter Fed, that's what he wants, I believe, Lisa. More purposeful in its communications, is better able to meet its objectives. To borrow a line from General Chuck Yeager, monetary economist, at the moment of truth, there are either reasons or results. That room didn't want to hear that. They don't want to hear a bunch of theorizing from General Yeager, one of our great heroes of high-speed aviation, or from this newly minted chairman. They want to know what that reaction is, what that process is. They want more Richard Clarida and less Chairman Warsh.
Well, maybe they got a little bit of what they wanted. Back with us, former Fed Vice Chair himself, Rich Clarida, as we await Michael McKee's return. Rich, were you satisfied with this speech? Did it give you confidence that this Fed Chair was prepared to hike rates in the face of 65 straight months of above-target inflation?
Oh, I think so. I think the work to do quote that you mentioned is the money quote, and I think that it delivered the reaction that the chair wanted. In particular, he also highlighted that the recent improving inflation data to him did not represent, he was not confident that was the trend. And so I think every meeting, including September, is live. But I think also that's about as much as we're going to get out of the chairman in terms of his reaction function, that there may be work to do.
I was surprised that he leaned so heavily into the 2% PCE objective is a firm fixed target, and the fact that we did hear from the Fed chair granular analysis of the components going into PCE and how broad-based inflation was. Rich, does that give you a sense that maybe this isn't somebody looking to overhaul inflation measurements, inflation targets, the way some people were expecting?
I think my interpretation is the chairman wants better measurements and better forecasts, but he made clear that the target by which the Fed will be judged is the existing target, which is 2% PCE inflation, which of course there was some confusion about that coming out of the July press conference.
You know, Rich Clarida, I remember interviewing Christine Lagarde here, and she was quoting Ernest Hemingway about the spirit and vision of America in this Wyoming. So I've got a chairman quoting Chuck Yeager. At the moment of truth, there are either reasons or results. Rich Clarida, is that what PhD monetary theorists want to be lectured on, to get reasons or results? Isn't it about process?
Well, ultimately, you hope the process delivers the results, and the chairman is correct that for the last 5 years, inflation in the U.S. and around the world has been above the target. And so he's focusing now on what the Fed needs to do to get it there. And in particular, as I mentioned, highlighting that some of the improving data that we've gotten since July, at least to him, does not indicate a material trend. And so he and the committee will be looking for additional improvement. And if they don't get it, I think they're prepared to hike.
Rich Clarida, thank you so much for being with us, and congratulations on missing out on the hike this afternoon that I hear some people are expected to take, even though it is currently absolutely pouring out there. Thank you again. That was the former Fed Vice Chair, Rich Clarida. Joining us now on set, staying dry under our tent, is, of course, the wonderful Kate Moore, Citi Wealth CIO. What did you make of the speech? Was it what a lot of people wanted from the market?
Yeah, I think Warsh delivered on what the market participants wanted. Number one, he gave some view of the economy, which I think was important. He indicated that it was strong, it was resilient. That's how we all feel. I love that he talked about profits, because that's incredibly important for us as investors. I love his commitment, once again, to the 2% inflation target, reiterating that that's something the Fed is laser focused on and not backing away from. And I think, you're seeing this sort of stability in the equity markets because we got what we needed from this speech.
Stability in equity markets, even if there is a hike. I mean, this is sort of the interesting note. You are seeing the expectation for a Fed funds rate hike for the September meeting go from before the hike at something like 35%, or before the speech to something like 35%. Now we're up to about 50%.
Yeah.
Is this acceptable right now? That's not necessarily going to take the froth out of equity markets.
Look, I think we should all expect September is a live meeting. We like the kind of 50-50 probabilities at this point because we don't exactly know how the data will come in, especially the CPI print that'll come in a couple weeks. I don't think the equity market is as sensitive to higher rates as the economy is. And I think that's the key driver here. Look at this quarter after quarter of double-digit blockbuster earnings growth, incredibly high revenues, raising guidance. I mean, that kind of momentum is not going to be derailed by a couple 25 basis point hikes in policy rates.
That's right where I wanted to go. And the heritage of his folks is Willem Bouter under Catherine Mann, who was just with us, now with the Bank of England, driving Citigroup economics. And now you've got Andrew Hollenhorst, who is way out front on higher rates and somehow will survive them. What I didn't hear in that speech was a discussion of the buoyant nominal GDP we're living now.
Yeah.
And the stock market is looking at nominal NVIDIA GDP and saying we can handle Warsh's higher rates.
We can. And look, we're really constructive on productivity growth. I think that's an important message. We heard
now or 5 years from now?
I think now to 5 years from now. Of course, as we know, forecasting 5 years from now is incredibly difficult. But we are seeing productivity growth. We think we're going to see more of it over the next 12 to 24 months. And I think some of that's getting priced into not just yields, but obviously into equity expectations as well.
Right now, there is a feeling that Chair Warsh is impatient. You are seeing this in markets if you are just joining this. The key line was when Fed Chair Kevin Warsh came out and said, here is our standard. We must be confident that underlying inflation is moving to our objective clearly and at a sufficient speed. Otherwise, we have work to do. Kate, does he lose the credibility if the FOMC does not hike in September?
I think the Fed needs to continue to be data dependent. And okay,
what does this mean? Because we just got data and it was disinflationary. Does that mean they don't hike? But at the same time,
we know we're looking at a several-month trend in terms of the inflation, and I just felt a lot of comfort from the message today that it's not going to be about a single print, that it's going to be about this kind of moving average, and that the Fed is committed to 2%. Look, if they don't hike at all in the balance of this year, I think they lose a lot of credibility. If it's September or October or later in the year, I think we can split hairs over that. But no hikes at all after this type of message would be a challenge. But September in and of itself doesn't change the credibility of the Fed.
Do they need to take back the 75 basis points of hikes that they delivered after the last FOMC meeting here in Jackson Hole?
I mean, there's a lot of stuff that needs to come out. And of course, we have to bring into the conversation the fact that we have midterm elections. And although the Fed is going to be apolitical to the extent that it can be, we do know that consumer behavior sometimes changes ahead of elections and that there's going to be a lot of noise. I expect a decent amount of volatility in the equity markets over the course of the fall because of policy, because of earnings, and because of the election.
Kate, stay close. Michael McKee just ran out from the room. It is raining. He somehow managed to avoid getting completely soaked. You were in the room. You heard the speech. What was the main feeling in the room as he was delivering a speech that frankly delivered a lot of what the market was hoping for?
Well, it's very hard to read the room because everybody is quietly listening to him. I looked at a couple of Fed officials who were watching the speech, and I didn't discern any kind of reaction. But I think even though he did not pledge that they would raise interest rates in September or beyond, he satisfied investors' concerns today. And you can see that in the futures market. In the 2s and 30s, the yield curve has flattened. And what we're seeing is basically the market saying, okay, that's what we wanted to hear. We wanted to know what your view on inflation was, and it's not good. And we wanted to know that you're committed to doing something, even if you're not saying you're going to raise rates, to bring it down to the 2% target.
I mean, I'm glad he quoted the monetary theorist Chuck Yeager. That was great to see. But Michael McKee, did you learn anything about his process forward? I did not.
Oh, I think we did, in the sense that he is not completely familiar to everybody because he's been out of the Fed for 15 years, and a lot of people have mined his previous work to see what he thinks. But he is looking at a variety of data, and what he's looking for is a stable view of where inflation is and is going. Right. So he's looking at that kind of data, and if he gets that, he's happy. Now, it could be improved.
Let's keep the show going right now. I need an umbrella. Can I get an umbrella right now, please? Seriously, can I get this? This is just
it's coming in a little bit. It's getting a little bit.
I did this with Alan Meltzer of Carnegie Mellon a number of years ago. I'm looking for an umbrella from our team right now. They're all dry, so they don't go. Kate Moore, it's raining on Lisa Abramowicz, but not on you, so I'll go to you while they straighten out the deluge that Abramo has right now. The heart of the matter, to me, within your responsibilities as a Citigroup, is a stock market can put up with this. That's all there is to it.
Absolutely.
There's all this navel gazing and, the stuff McKee lives on. And the answer is it's one big so what for the equity market.
Well, I think the important point also from the speech was Warsh indicating that he didn't see really any signs where financial conditions were restrictive at this point. And that is the experience of almost every company we talk to in every industry. They're saying the same thing. There's nothing in the rate environment that's restricting their behavior. And since we know so much, oh gosh, I'm so glad the umbrella's here. Hopefully the storm passes quickly.
I'm fine. Really, I'm fine.
What
Please
about
carry on.
You still look great.
Thank you.
That's the most important part of it. But
I did this for Alan Meltzer 15 years ago.
So you're just trying to recreate that incredibly joyful memory.
Continue. Carry on with the show, please.
Look, it seems like people are unfazed right now in terms of the potential risk appetite. It does seem, though, like we did get a sense of why he wasn't explaining why the Fed remained on hold. He said that sometimes giving a sense of what past policy was or giving past history is misconstrued as what's going to be coming ahead. What do you make of that in terms of not even giving the rationale to why the FOMC makes the decisions that they do?
Well, I'm going to take this back to how I think about the investing framework in general, which is I always say to my analysts and people that work with me that, you cannot drive the car by looking in the rearview mirror. And it's so frustrating when people say this is the historic relationship between these stocks or between this economic data point and the market, and then try and project forward. So I have great sympathy with this overall sentiment that taking historic data or historic precedent and experience and then trying to project that out into the future is a failing game. I did love also that Warsh talked about AI, token usage, and how that's really affecting large parts of the economy. And of course, again, going back to this productivity point, will effectively, I think, help drive productivity in the future, the adoption of these tools.
As the chief investment officer of Citi Wealth, when you hear this kind of speech at a time coming off all of the angst that we had been feeling in markets, does it give you more conviction to go into long-term U.S. bonds, to go into U.S. assets and overweight some of the U.S. instruments over the rest of the world?
I mean, that's a tough question. I'm going to separate out the bonds from the equities. We have been significantly underweight duration for a considerable period of time, the entire duration of my 18 months as Citi CIO. What I will say is I feel very little reason, given the fiscal backdrop, and really no impetus to add to duration or to add to our underweight in bonds. What I do feel highly convicted in is the underlying growth story, the breadth of that growth, how what's impacting Capex in many different sectors and industries. I feel really good about our U.S. equity stance and continuing to lean into the secular earnings growth.
Okay, I want to bring in Kate Moore here and Michael McKee on this. With Michael McKee, I've got an expert on the 5 and 10-year, 20-year lag mystery of productivity, and you're worried about what are we going to do with earnings ending September 30. So productivity is the great salvation of Besant. The bottom line is we're going to do a Besant methodology, which Druckenmiller pushes against, because productivity is going to come to the rescue. Mike McKee, what is the evidence that productivity can come to the rescue?
Well, there's no evidence. If you're talking about AI productivity, there's no evidence in the data yet. There is a supposition based on on what AI could do to raise productivity, but we really don't have an idea of how much that will be. Obviously, the AI proponents are saying this is going to be a game changer and it's going to do a lot.
Right.
We had the same thing happen, of course, in the 1990s with personal computers and the old Robert Gordon saying about productivity is everywhere except in the data. It takes a while because companies have to learn how to use this tool, and they have to restructure their companies to do it. So we're not going to have any benefits for Kevin Warsh and productivity in holding down inflation for some years.
Okay, but so the giant of Northwestern had a lot of caution in the 90s. Hollenhorst out of UCLA is skeptical, I'm sure academically. We don't really know where productivity is going. What would you say to Secretary Treasury Bessent right now about this big gamble on productivity?
Look, we're constructive on productivity because although it's not always showing up in the data, and Michael's making a great point here, the conversations we're having with companies indicated in significant pockets of their business operations, they are actually seeing efficiency gains. This is what I would also say. We're talking, obviously, we're here in Jackson Hole. I think it's going to clear for us at some point.
50-50 chance.
But we also have the G20 finance ministers meeting coming up this weekend as well, where, you know, Secretary Bessent will be there. And I'm very interested to see how he talks about both, you know, the interventions from the Treasury and then future expected behaviors, because this is going to be a lot for the market to digest. We got good news, I think, from Warsh, as Michael was saying as well. We got all of the boxes checked that we needed to hear. And now we have to get a sense for where other parts of the policymakers are going to play.
You know, Kate brings up a great point. Mike, you and I were talking about that this morning. It's pretty unusual to have an event scheduled so close to the Jackson Hole meeting, where it really is a conflict of schedule for so many of the people who would normally be here. I mean, the G20 taking place in Asheville, I believe, on Sunday.
Yes, it's our Sunday. It's obviously inconvenient for both sides, but we haven't seen that before in terms of the scheduling. I don't know why it was scheduled that way, but a lot of the central bankers who might ordinarily be here are not coming because it's too much to go back and forth.
Well, I know that, Kate, you are here because you have a home here and you very much love this, as we do. I'm just curious for you, walking away from this, did it seem like a big market moment to you? Do you think that this was a pivotal speech that will go down in the pantheons of Fed chair speeches, like the Payne speech and like some of the others that potentially kicked off an era that we can reflect upon?
Oh, gosh, I wish I had that crystal ball. What I will say is, again, I'm going into the rest of the market trading day, into next week, feeling comfort, you know, from all of this. I want to say I also know that Chair Warsh is a big fan of Jackson and of Grand Teton National Park. I loved how we talked in the beginning about the two different types of hikes that we can do, and I hope certainly that the weather clears so that participants here can get out a little bit in this beautiful country.
Kate Moore, thank you so much. Wonderful to see you as always. Kate Moore of Citigroup and Michael McKee, thank you as always for all the context and wonderful insights. Yeah, we heard about, you remember Paul Volcker. He showed up famously late to the dinner the first year, to the Thursday night dinner, wearing his fly fishing outfit in a carefully orchestrated moment where he was trying to demonstrate his love of the outdoors.
McKee knows the history better than me, but basically the reason this started for the Kansas City Fed as part of their district was a bribe to get Volcker to show up simply because of fly fishing. Right. Basically, they said, how can we get Volcker here? And the answer was fly fishing. Let's put it in Jackson Hole.
If you wanted to fish for a hawkish response, oof, I'm groaning for myself. You could take a look right now at markets. Take a look at 2s, 10s, and 30s. You can see the front end of the yield curve markedly higher, up about 7 basis points currently, leading to this yield curve flattening that people were looking for on the heels of this. Right now, 4.30 on the 2-year, on the 30-year, lower now by 4 basis points. So the 30-year is what people were looking for a response about how much faith people had in the Fed bringing inflation under control. Fed Chair Kevin Warsh speaking just moments ago. Take a listen.
Now, there is one signal nobody can miss. The responsibility for 65 months of sustained elevated inflation sits squarely with the central bank, and that's where it belongs. So here is my standard. We must be confident that underlying inflation is moving to our objective, clearly and at sufficient speed. Otherwise, we have work to do. That's our job, that's our mandate, and that's our charge to keep.
Joining us now on to set here in rainy Jackson Hole, the hosts of Bloomberg's Odd Lots podcast, Tracy Alloway and Joe Weisenthal. Welcome. Thank you for being here in this incredible weather. Tracy, what was your take? It seems like we got the hawkish move in terms of the speech that people were looking for. How much does this sort of make it important for them to follow through later this year.
Yeah, well, I thought one of the funny things about the speech was apparently it's one of the longest Fed chair speeches at Jackson Hole in history. It's like 3,600 words, which for a guy who says he doesn't like forward guidance, it seems like a lot of talking, right? But I think it goes back to the idea that he was trying to correct some of the last presser, and the fact that he did explicitly mention that the Fed cares about PCE is probably what the market was looking for. That said, I think the more people kind of digest this, the more uncertainty they're still going to see around the reaction function. And the key thing for me was when Warsh was talking about he has to see inflation at sufficient speed. What is sufficient speed, right? Like we know inflation above target is bad, but like the speed at which it's moving, that seems very subjective.
Well, Joe Weisenthal knows that you are who you quote in your speech.
That's
so
right.
he quoted the monetary theorist Chuck Yeager, grew up dirt poor in West Virginia, and did all of our physics, all of our aerospace, high up in the air. What do you make of the quote from Yeager, which to me signaled he didn't want to talk about process? It was just about this and that.
No, I mean, look, I think I would give him a lot of credit for stopping just short of the obvious implication, but making the obvious implication clear, right? So the other thing he said was clearly he does not consider policy to be restrictive right now, or insufficiently restrictive. And he also talked about, inflation generally going in the wrong direction. So if you don't think that policy is sufficiently restrictive, and if inflation is not going in the right direction, 99% of the time that leaves you to one obvious conclusion. And so, again, it's not forward guidance, it's not hand-holding, etc., but it is an articulation of the fact that basically, for the first time since he's been the Fed chair, this sort of indication that's like, policy needs to get restrictive. There's a tool to do more, that's called rate hikes. Hence, we see the move at the 2-year that would be inferred.
I mean, odd lots is way too hip, and they're so au courant for me. You people are in Los Angeles here in a number of days a week. Tracy Alloway, when we talk about productivity, innovation, that's what the papers are about, right?
Stablecoin. They're talking about the use of the dollar in stablecoin.
A lot of people don't believe any of it. Kate Moore's here believing in productivity. With all the interviews you do you believe in productivity?
Do I believe in productivity?
But they're both incredibly productive. I think they're demonstrating
I like to
productivity.
say that in my daily work, I sometimes witness productivity. But no, productivity obviously a huge topic because for Warsh especially, it's like his giant get out card, right? If we do get the productivity boom, if that ends up as a deflationary force on some prices, then he really doesn't have to be as hawkish as he might otherwise not want to be. Do we see evidence of it right now? Not yet, right? In the numbers that we're looking at, I don't think we've seen the big productivity boom. It's this kind of thing that's always coming down the road, but we talk a lot about it, but we have yet to see it in the actual numbers.
For example, you could imagine that we could cover a Jackson Hole speech from our computers at home in Bloomberg and save all kinds of, time and effort, et cetera. There could be an imagination.
What are you doing? What are you doing? I mean, the truth is, not only do we enjoy the environment, but it's also wonderful to get the tangible sort of discussions
and you meet
and
a lot
feeling
and you meet
the
a lot
air.
of people.
What are you doing?
No, absolutely. I unironically get there's a tremendous amount of value from the people we get to meet and talk to at one location. I'm just being facetious, but it is the big thing. That's clearly everything else, setting aside inflation, setting aside employment. That is the get out of jail card for everyone in every economy. It's how much more can you get per some labor input? Hence why I thought it was very interesting, probably a first in history, 3 paragraphs about AI token prices.
Yeah, that was interesting.
That's very interesting. And that's going to be a big deal. And not just the cost of AI token, but thinking about, is this competition for labor? How do we think about where in the classical factors of production AI services fit in as a big
I know we
deal.
got to wrap it up quickly here. I love what Terry Haynes said of Pangea policy. It's a sagebrush Davos. Everybody's looking at AI in this. You know what? Half of America's flat on their back.
Tracy Alloway, Joe Weisenthal, both of you, thank you so much for being on set with us here. We did just hear from the Fed chairman himself, Kevin Warsh, as he came out saying that essentially they will not tolerate inflation above target for much longer. You are seeing the 2-year respond aggressively to that. My takeaway from this is that ultimately this is an FOMC prepared to hike rates, and that is what you're seeing in these markets.
I think they're hugely data dependent. Beth Hammack started us off with that. matter, and that's what they are.
Data dependency means that PCE is that much more important, as well as all of the components. Coming up, stay tuned for more interviews out of Jackson Hole throughout the day. I'll be speaking with Bank of England Governor Andrew Bailey. Oh, Tom has the umbrella out. IMF Managing Director Kristalina Georgieva, and Tom will speak with Harvard University Professor Ken Rogoff. I'm not getting rained on, Tom. I am completely fine. Thank you.